Insurance controls global oil flows, not speeches, not hashtags, not even navies most of the time. It happened quietly, and it should have been everywhere. While politicians argued about price caps and sanctions, oil kept moving. Cargoes kept arriving, refineries kept running. And the only reason that is possible is because the world does not run on barrels. It runs on permission. A barrel is useless until it can move, dock, unload, get paid for, and get insured. That last word is the one most people never track because it sounds boring, and boring is where the real power hides. Recently, the public story got louder, the cap number moved down, the ship lists got longer, the language got tougher, and yet the physical flows did not just stop. So the real mystery is not why leaders talk. The real mystery is why the world keeps obeying the same invisible gatekeeper. And if you stay with me, you are going to get the exact map of how a barrel travels under sanctions. The 3 dials that tell you when enforcement is tightening before headlines arrive, and the simple way to think about which companies quietly win when shipping and insurance become weapons. Because you did that. You watched energy prices and thought the whole story was supply and demand. You saved time by ignoring the logistics layer. You paid for it anyway, because the logistics layer sets the hidden tax that shows up later in groceries, goods, travel, and inflation. Now, before we go any deeper, do one thing that actually helps you and helps this channel. Hit like, subscribe, and share this with one friend who still thinks sanctions are just a switch that turns oil off. Because when you understand the gatekeeper, you stop being surprised by the same pattern repeating. Now let S walk into the scene like a camera that refuses to look away from the quiet detail. A tanker can be full of crude and still be effectively banned from the world economy without a single missile being fired. Not because the ocean is blocked, because the paperwork is blocked, because the ports are blocked, because the insurers are blocked, because the liability is blocked, and liability is the real chain. Here is the simple fact that changes everything. Most global ocean shipping relies on a small network of marine insurance and liability coverage that, in normal times, covers the vast majority of ocean-going tonnage. Think about what that means in plain life. It is like one set of keys opens most doors in the building. You can argue about the tenants all day, but the landlord with the keys decides who enters, who leaves, and who gets locked out. And the way this power works is almost insulting in its simplicity. A ship is not just a ship. A ship is a floating lawsuit. If it spills, if it hits another ship, if it damages a port, if it injures crew, if it destroys cargo, somebody must pay. The number is not small. A major spill can mean billions in claims, cleanup, and long legal fights. So ports, lenders, counterparties, and governments all ask the same question before they touch the cargo. Who is insuring this liability? If the answer is wrong, the cargo becomes radioactive. Not because the oil changed, because the risk changed. Now you see why sanction enforcement loves services. You do not have to chase every barrel. You just have to control the services that make barrels usable. And once you see that, the price cap system makes sense. The price cap is not mainly a price control in the way people imagine a price control. It is an eligibility rule. It says, if you want to use normal Western shipping, financing, brokering, and insurance services, you must comply with the cap. If you do not comply, you must exit the normal system. You must build a parallel route, parallel ships, parallel paperwork, parallel insurers, parallel payment channels, and that is where the world discovered something strange. Oil can keep flowing even when you tighten rules, because demand still exists and money still moves. But the cost of flowing goes up, and the risk goes up, and the hidden tax goes up. You did that. You saved money when prices eased at the pump. You paid when the hidden tax showed up in freight costs, insurance premiums, and supply chain friction that hits everything, not just oil. Now let's talk about the shadow fleet, because that phrase sounds dramatic, but the reality is more dangerous than dramatic. A shadow fleet is not a single fleet with a flag. It is a pile of older tankers, shifting ownership, shifting flags, shifting routes, and sometimes questionable insurance arrangements. It is a logistics workaround built under pressure, and whenever you build a workaround at scale, you pay in efficiency, you pay in safety, you pay in cost. Here is the number lens that matters. If a sanctions regime pushes trade into longer routes and older ships, You effectively reduce global capacity. Even if the world still has the same number of ships, longer routes mean each ship completes fewer trips per year. If a route becomes 10 days longer each way, that can add 20 days round trip. If a tanker used to complete 6 voyages per year and now completes 5, you just lost about 1/6 of its annual carrying capacity. That is not politics. That is math. Now scale it. If hundreds of ships are rerouted, delayed, inspected, slowed by paperwork, and forced to take longer paths, the system loses effective capacity. When effective capacity drops, freight rates rise. When freight rates rise, costs rise for everyone, even for people who have never heard the phrase shadow fleet in their life. You did that. You assumed geopolitics is far away. You saved yourself the mental load. You paid when the costs arrived through prices that had nothing to do with your country's politics. Now, here's the part that turns this into a story about leverage and fragility. A normal vessel in the normal system is like a person with a valid passport, health insurance, a clean credit file, and a job. They can pass through doors, they can dock, they can borrow, they can settle disputes. A vessel in the shadow system is like a person living on cash with a changing address, questionable paperwork, and no reliable insurance. They can still move. But every door is harder. Every door is riskier. Every door can close overnight. That is why this is not just about whether oil flows today. It is about how stable those flows are when something breaks. Because something always breaks. And when something breaks, the whole world cares about one question. Who pays? If you cannot answer who pays, ports get nervous. Banks get nervous. Counterparties get nervous. And nervousness is how liquidity disappears. Now let me make the hidden tax concrete with a number that hits like a receipt. Most world trade moves by sea. That means shipping costs are not a niche. Shipping costs are the bloodstream cost of the global economy. When you disrupt a major choke point, even for months, you do not just shift oil. You shift everything. You shift containers, you shift spare parts, you shift electronics, you shift food inputs, you shift fertilizer, you shift industrial components, and the effect is always the same. Longer routes mean higher costs. Higher costs mean higher prices. Higher prices mean inflation pressure. Inflation pressure means higher interest rates or slower cuts. And higher interest rates mean every asset you own is repriced. You did that. You thought sanctions were moral theater. You saved yourself from watching the logistics ledger. You paid because the logistics ledger writes checks your household cash flow must cover. Now, before I give you the 3 dials, you need one more piece. Because without it, you will misunderstand why enforcement sometimes looks strong and still fails to stop flows. The world does not need perfect compliance to keep moving. The world needs enough ships, enough insurance equivalents, enough payments, enough buyers, enough refineries, and enough willingness to accept risk. So when you tighten the normal system, you do not instantly delete trade. You shove trade into higher risk channels, and those channels demand discounts. That is the second hidden tax. Discounts are not generosity. Discounts are compensation for risk. If a buyer gets a discount of $5 per barrel and they import 1 million barrels per day, that is $5 million per day. That is about $1.8 billion per year. Now imagine the discount is $10. That becomes about $3.6 billion per year. That is why buyers show up. Not because they are making a political statement, because they are buying cheap feedstock, improving margins, and feeding their economy. So you can tighten enforcement and still see flows, because the discount is the lure. You did that you thought the world runs on ideology. You saved yourself from recognizing the real driver, cash flow. You paid because cash flow is what makes the workaround durable. Now, here is the uncomfortable part that people avoid. Parallel systems can work for a while, but they tend to be brittle. Older ships break more. Opaque ownership creates legal risk. Weak insurers create claim uncertainty. And uncertainty is expensive. So the world pays for the workaround in 3 ways. Higher freight, higher insurance, higher accident probability. Now imagine one major incident. A spill, a collision, a fire, a port refusing entry, a cargo seizure, suddenly the whole parallel network looks like a liability bomb. That is why this topic matters. Because the risk is not only price, the risk is discontinuity. Prices you can hedge. Discontinuity is what surprises portfolios. Now, let's zoom out and connect this to the way your life actually gets priced. Energy is not only gasoline, energy is embedded in everything. It is embedded in production. It is embedded in transport. It is embedded in plastics. It is embedded in chemicals. It is embedded in food. So when shipping and insurance costs rise, it pushes a wedge into the entire cost structure. Companies try to pass the wedge through. Some can, some cannot. If a retailer operates at a 3% net margin in shipping and logistics costs rise by 1% of revenue, that is not a small problem that can wipe out a third of net profit. If a manufacturer has a 10% operating margin and their input costs rise 2%, that can cut operating profit by 20% if they cannot pass it through. That is why this story belongs in an investing channel. It is not a war story. It is a margin story. You did that. You watched earnings reports without watching the input pipeline. You saved time. You paid when margins compressed, and you blamed management, even though the real villain was the invisible tax. Now, here is the promise again, because this is where most people lose the thread. You are about to get the one choke point that can freeze a cargo without stopping a ship. And once you understand it, you will understand why sanctions sometimes look weak and sometimes look terrifying. But before I hand it to you, you need to know how a barrel actually travels in the modern system. A barrel starts at production, then it enters storage, then it is sold on a contract, then it is assigned a vessel. Then that vessel needs financing for the cargo. Then it needs shipping, documentation. Then it needs insurance, coverage. Then it needs a port destination that will accept it. Then it needs a buyer that can pay through a bank that will clear it. Now notice something. Achi every steppy services touch the barrel, and services are where enforcement lives. So the choke point is not the oil field. It is the service layer that turns oil into legal trade. If you can choke the services, you can choke the trade, even if the oil exists. Now, here is the choke point. Insurance and liability cover. Because insurance is the paper shield that makes ports and counterparties comfortable. Without it, the ship is not just risky. It is unacceptable to many normal ports and many normal counterparties. So insurance is a border that floats on water, and the strongest border is the one you do not see. You did that. You focused on the border on land. You saved yourself from learning the border on water. You paid because the border on water decides the hidden cost of your economy. Now let's place the companies and sectors on the board, because viewers do not just want to understand. They want to map impact. When insurance and sanctions complexity rise, there are clear toll booths, insurance brokers, and risk advisors. Mosh, McLennan, and Ayon. When complexity rises, compliance budgets rise, and broking demand rises. Reinsurers can see pricing power in certain cycles. Munich Re, Swiss Re. Not every year, not every cycle, but the mechanism is simple. More risk means higher premiums until losses catch up. Then the cycle resets. Now shipping and logistics. When freight rates spike, certain container liners and logistics operators can see revenue surge, but it is cyclical and politically sensitive because high rates create backlash. So you treat it like a cycle, not a forever story. Now, defense and maritime security. When shipping lanes become contested, surveillance, defense, and security spending tends to rise. Companies like RTX, Lockheed Martin, Northrop Grumman become relevant not because war is good, but because governments pay for security when risk. Now energy majors, ExxonMobil, Chevron, Shell, BP. These firms are complex. They can benefit from volatility in trading arms. They can also face political and regulatory risks. So their advantage is scale, integration, and optionality, not immunity. Now, the companies that suffer, import-heavy retailers with thin margins, manufacturers without pricing power, any business whose cost structure is sensitive to shipping and energy and cannot pass it through. These are the firms that get squeezed quietly while the world argues about politics. You did that. You bought what looked strong In the last regime, you saved time by not mapping input exposure. You paid when the regime shifted and the input pipeline rewrote profit margins. Now, before we go to the three dials, take a breath and see the pattern. This entire story is a story about gatekeepers. Not a single gatekeeper, but a chain, ports, banks, insurers, brokers, class societies, compliance. Each of them is a door. The more doors you must pass through, the more power the system has to shape behavior without firing a shot. That is why policymakers focus on services, because you do not need to catch every ship. You only need to control enough doors that most ships cannot afford to ignore you. And the moment ships choose to ignore you, they pay the shadow tax. Higher risk, higher cost, higher fragility. That is why the shadow fleet is not a victory for anyone. It is a symptom of a divided system. And divided systems are expensive. Now, I am going to give you the three dials next, but only after we lock in one last truth. A policy can be called a cap. A policy can be called a sanction. A policy can be called enforcement, but the market only cares about two numbers: how much supply is moving and what it costs to move it. If oil still moves, the world still functions. If oil moves but costs more, the world still functions but everyone pays. If oil stops or stutters, the world panics. So the three dials are not about moral arguments. They're about whether costs are rising, whether flows are stable, and whether the service layer is tightening. If you want the next section where we build those dials in a way you can track weekly, hit subscribe now. Share this with a friend who thinks oil is only about drilling, because this is about shipping, paper, and permission. And stay with me, because in the next part, we will map the three dials. We will show you how a single designation can change war risk premiums overnight. And we will connect it directly to what happens to inflation, interest rates, and your portfolio when the invisible gatekeeper decides the door is closing. Insurance controls global oil flows, not speeches. It happened quietly, and it should have been in the news everywhere, because it changes how sanctions actually work. It changes how wars get financed, and it changes why prices can spike even when supply looks fine on paper. A cap number can move down, a sanction list can grow longer, a government can swear enforcement is tightening, and the ships can still move. The barrels can still arrive, the refineries can still run. So you start asking the only question that matters. If the rules are tightening, why is the physical oil still moving? And if the oil is still moving, what exactly is being controlled? Here is the answer. And it is going to sound boring until you realize boring is the thing that runs your entire life. It is not the barrel that is controlled first. It is the permission you did that. You watched crude prices and assumed the story was only supply and demand. You saved time by ignoring the logistics layer. You paid for it anyway because logistics is the hidden tax that shows up later in groceries, flights, plastic, rent, and interest rates. Stay with me because by the end you will have a clean map you can reuse anytime you see a sanctions headline. You will know the three dials that tell you enforcement is tightening before the media catches up. And you will know which companies quietly win when the world turns, trade into paperwork and risk premiums. If you want more episodes that turn headlines into real numbers and real money flow, subscribe now and share this with one friend who thinks sanctions are a simple on-off switch. Now, let's walk into a scene that most people never imagine. A tanker is a city block-sized piece of steel filled with tens of millions of dollars in cargo, moving through the ocean like a moving bank vault. But it is not the cargo that makes it valuable. It is that everyone agrees it is tradable. The moment that agreement breaks, the tanker becomes a floating liability. And liability is the real chain around the ankle of global trade. A ship is not just a ship. A ship is a lawsuit waiting to happen. If it spills, if it hits another ship, if it damages a port, if it destroys cargo, if it injures crew, someone must pay. And the numbers are not small. A major accident can mean claims that run into the billions. So every serious port, every serious counterparty, every serious bank, every serious buyer asks one question before they touch the deal. Who is covering the liability? If the answer is not acceptable, the oil becomes untouchable. Even if it is cheap, even if it is needed, even if it is already at the dock. That is why insurance is not an accessory. Insurance is a border, a floating border, a border that can stop trade without stopping ships. Now let me make the mechanism feel real. Think about your own life, you can have a car, a job, and a destination. But without valid insurance, a lot of doors close. Financing gets harder. Leasing gets harder. Certain roads and requirements become risky. Now scale that to a giant tanker. Ports are not charity organizations. Ports are risk managers. They do not want a ship that can bankrupt the port authority if something goes wrong. Banks are not moral philosophers. Banks are risk managers. They do not want to finance a cargo that becomes legally toxic. Counterparties are not loyal. Counterparties are risk managers. They do not want to be the last person holding a contract when regulators come knocking. So when you control insurance and the service layer around insurance, you control the acceptance of the cargo. And now you can see why the world's most powerful sanctions are not always the loudest. They are the ones that target services. Not because services are glamorous, but because services are the rails. You can still have oil on the ground and still have oil in storage and still have oil on a ship, and yet the trade can freeze if the rails are removed. You did that. You thought power was only about who owns oil fields. You saved yourself from learning about the rails. You paid because the rails determine whether costs rise quietly across everything you buy. Now let S build the barrel S journey so you can see where the choke points actually live. A barrel is produced, then it enters storage, then it is sold on a contract. Then it is assigned a vessel, then the cargo is financed. Because few buyers pay for giant cargoes with a suitcase of cash. Then the vessel needs classification, documentation, and compliance. Then it needs insurance, both hull insurance and liability cover. Then it needs a port that will accept the ship and allow it to unload. Then it needs a buyer that can pay through a banking channel that will clear. Then it needs a refinery that can process it and a product chain that moves it into gasoline, diesel, jet fuel, plastics, chemicals. Notice how little of that is about the oil itself. Most of it is about permission, paperwork, and risk. So when a government says we are tightening sanctions, the question you should ask is not do they have strong words? The question is where are they tightening the rails? Now you understand the price cap story in a way most people do not. The price cap is not mainly a magical spell that lowers the oil price. It is a rule about service eligibility. It says if you want to use normal Western shipping services, normal Western insurers, normal Western finance, normal Western brokering, you must comply with the cap. If you do not comply, you can still move oil, but you must do it outside the normal system. You must build a parallel route, parallel ships, parallel paperwork, parallel insurers or insurer substitutes, parallel payments, and the parallel route is not free. It is more expensive, more fragile, and more dangerous. That extra cost is the shadow tax. And that shadow tax is why you can see oil still flowing while the global economy quietly pays more for the same barrel. You did that. You assumed a cap means the price just goes down. You saved yourself from tracking the workaround. You paid because the workaround pushes hidden costs into shipping, insurance, and eventually inflation. Now let's talk about the shadow fleet in a way that keeps it grounded. People hear shadow fleet and imagine a single coordinated armada. The real world is messier. It is a patchwork of vessels, often older, often changing flags, often with ownership structures designed to be hard to trace, moving cargoes in ways that reduce visibility. Some of these ships do what they do because they have to. Some do it because the profit is real, because when the normal route is blocked, the workaround route gets paid. And whenever a workaround gets paid, a new industry forms around it. But the shadow fleet has a weakness that the normal system spent decades solving: trust. In the normal system, trust is outsourced. Ports trust certain insurers. Banks trust certain documentation standards. Counterparties trust certain legal frameworks. When you exit that system, you replace trust with discounts, risk premiums, and sometimes outright denial. So here is the number that matters. The world does not just pay for oil. The world pays for the cost to move oil. If the workaround adds even a few dollars per barrel in extra friction, that is not small. If 1 million barrels per day move under higher friction, and the friction is $5 per barrel, that is $5 million per day. Over a year, that is roughly $1.8 billion. If the friction is $10, it is roughly $3.6 billion. And that is just 1 million barrels per day. Global flows are much larger. So you can see why the workaround exists. The money is real. And you can see why the hidden tax matters. Because the money does not disappear. It gets paid by someone, either by producers through discounts, or by buyers through higher delivered costs, or by consumers through higher prices downstream. You did that. You assumed sanctions only hurt the target. You saved yourself from learning the chain. You've paid because the chain always pushes some costs into the global system, and the global system pushes costs into your life. Now, the part nobody likes to talk about, when you push trade into older ships and longer routes, you create fragility. Longer routes reduce effective capacity. Here is a simple picture. If a route is diverted and becomes 10 days longer each way, that is 20 extra days per round trip. If a tanker used to complete 6 voyages in a year, and now it completes 5, you effectively lost around 1/6 of its annual capacity. Multiply that across hundreds of ships, and you have a global capacity reduction without losing a single ship on paper. When capacity tightens, freight rates rise. When freight rates rise, delivered costs rise. When delivered costs rise, inflation pressure rises. When inflation pressure rises, interest rates stay higher for longer. And when interest rates stay higher for longer, every asset is repriced, every mortgage is repriced, every corporate refinance is repriced. That is the chain. It starts with the ship. It ends with your monthly payment. You did that. You treated shipping as a niche topic. You saved time by ignoring it. You paid because shipping is a multiplier on everything you buy. Now bring in the other layer that people ignore until it hits them. Marine insurance is not just a price. It is also an acceptance stamp. A ship can have some insurance somewhere, but if the port authority and counterparties do not accept it, it is like having a credit card that only works at one store. So when rules tighten, you watch the acceptance layer. Not what the ship claims, what the ports accept. And when a major bloc starts expanding lists of sanctioned ships, that creates a wave of risk that spreads beyond those exact hulls. Because everyone associated with the cargo starts asking, am I next? That question changes behavior. Behavior changes routes. Routes change costs. Costs change prices. Now you might be thinking, if insurance is that powerful, why does anything move at all under sanctions? Because trade does not require perfection. It requires enough ships, enough intermediaries, enough buyers, enough insurers or insurer substitutes, enough ports willing to accept risk, enough banking channels, and enough discounts to make it worth it. That is why a tightening regime can reduce revenue and increase friction without completely stopping flows. If the target can still sell volume, but at a lower price, revenue falls even if exports continue. And that is a key difference between volume and value. You can look at the same system and say, exports are still happening, so sanctions failed. But if price discounts widen and the target's revenue collapses, the financial pressure is real. This is why you measure not only barrels per day, you measure dollars per day, and then you watch who captures the difference. Because the difference does not vanish. It goes to someone, it goes to a buyer through a discount. It goes to an intermediary through a premium. It goes to a shipping owner through higher freight. It goes to an insurer through higher premiums. It goes to a broker through fees. It goes to a trader through spreads. So let's name the toll booths, because that is where viewers actually learn to position in a world like this. When risk and complexity rise, insurance brokers and risk advisors become more relevant. Marsh McLennan, Aon, when clients face more compliance rules, more routing uncertainty, more risk events, they spend more on advisory, placements, and risk management that can support revenue and pricing power in that segment. Reinsurers can see pricing cycles tighten when risk rises depending on losses and the market cycle. Munich Re, Swiss Re, not because they love chaos, but because risk is their product. And when risk is repriced, premiums change. Now look at market infrastructure and information. When sanctions and compliance complexity rise, demand for data, screening, and monitoring rises. The boring work of checking counterparties and vessels becomes urgent. That can support budgets for compliance, tech, analytics, and monitoring. Now, defense and maritime security. When trade lanes become contested, governments and companies spend more on surveillance, protection, and security systems. That tends to support firms like RTX, Lockheed Martin, Northrop Grumman, not as a moral statement, but as a budget reality. Now, shipping and logistics. When freight rates spike, some shipping companies can benefit in the short term because the same fleet can earn more per voyage. But this is a cycle, and it is politically sensitive. High freight rates invite intervention, new capacity, and eventual normalization. So you treat it like a regime trade, not a forever guarantee. Now the losers, import-heavy businesses with thin margins, manufacturers without pricing power, retailers where a small cost increase can erase profit. A company with a 3% net margin cannot absorb 1% of revenue and extra logistics costs without taking a major hit. That is why, in this kind of world, pricing power becomes a superpower. And balance sheet strength becomes a shield. Because when costs rise unpredictably, only the firms that can pass costs through or absorb them survive without damage. You did that. You bought companies based on the last cycle. You saved yourself from mapping input exposure. You paid when the cycle shifted and hitting costs attacked margins. Now, I want you to feel the biggest point in your bones. The world economy does not stop because someone makes a rule. The world economy bends around the rule, and the bending costs money. So the question for you is not wallow you still. The question is, what will it cost to keep it moving? And who pays that cost? And who profits from that cost? Now we are ready for the most useful part of this entire episode. The 3 dials you can watch like a pilot watching instruments, but I am not going to throw them at you like a checklist. I want you to understand why each dial matters. Because if you understand the why, you can recognize the pattern even when the headline uses different words. Dial 1 is enforcement velocity, not one announcement. The pace, how frequently new ships, companies, and services are added. If designations and lists start accelerating, that means the normal system is shrinking. More trade gets pushed into the workaround. Workaround means higher friction. Higher friction means higher costs. Dial 2 is the price of risk in shipping. War risk premiums, insurance, surcharges, freight rate spikes, rerouting announcements. If you see these rising while crude prices are calm, it is a warning that the delivered cost of energy and goods is rising under the surface. Dial 3 is discounts and buyer concentration. When trade moves into narrower channels, discounts change and buyers become more concentrated. If 1 or 2 buyer blocks absorb a larger share, they gain leverage to demand better pricing. Better pricing for them is lower revenue for the seller. Lower revenue changes the war finance math, and that changes policy behavior. That is the chain. Now, in the next part, we are going to turn those 3 dials into numbers. You can actually track week by week. We are going to show you exactly how a single new list wave can change premiums and routes, how rerouting translates into capacity loss, and how that capacity loss translates into inflation pressure. And then we will close by giving you a clean company impact grid with names, mechanisms, and timeframes. So you stop guessing and start mapping.